Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining us this afternoon, we have Davitt, Head of Index Options Content at Nasdaq, as well as Craig Peterson, CEO of Tier1 Alpha, and we're here to discuss why systematic strategies react reflexively to changes in volatility. Gentlemen, it's great to see you both. Welcome to Trade Talks. I want to kick it off with you over there at Tier1. Craig, let's discuss how you interpreted the recent volatility that we've seen in the markets over the past few weeks, because it has been relatively muted for 2024.
Yeah, that's correct. We've seen a lot of volatility suppression over the past year and a half. And a lot of this is coming from things like structured product issuance. We're seeing a lot of call selling, specifically from derivative income ETFs. And what this has done is drive realized volatility down to some of the lowest levels that we've seen really since 2017. And part of the effects of this, when we talk about systematic flows, is a lot of these systematic strategies are linked to realized volatility. And the lower that volatility gets, the more equity exposure they're allowed to hold. And that was kind of our first clue that these funds were starting to be maxed out at about their peak leverage, the max amount of equity exposure that they're going to have. So this told us that there's a underlying risk in the market lingering in the background. And the second we started to see some volatility increase, that's when we knew that these funds were going to be forced to sell.
Yeah. And Kevin, following on that, today's another standard options expiration. Can you give us a quick rundown of what made the August cycle unique?
Yeah, I think Craig alluded to the background leading into this cycle. I have to say, I think their research is exceptional. Personally, it triggers ideas from a content perspective as well as from a personal trading perspective, and he's going to highlight some more what they do best. But what I'll do is focus on how much higher realized volatility has been during this August expiration cycle. So the visual we have here illustrates the average daily close over close move in the NDX per expiration cycle. So the average in 2024 through the July cycle, or 1 month ago, was like 77 basis points, well less than 1% today. So if we're being a little bit more clear, that is a plus minus figure. And in vol terms, it would equate to an annualized volatility level for the NDX around 12.5. That's what Craig was referencing not long ago with comparisons to 2017. Now that started to change in early July. On the 11th of last month, we got just the second sell-off of greater than 2% in the NDX in this calendar year. Then it happened again on the 17th, right before July expiration. Now, with the benefit of hindsight, we now know that equity indices made all-time highs around the 10th of last month. As you can see, realized volatility really picked up during this August cycle. The average has been more than double what we observed the rest of the 2024 cycles. And the annualized vol over the past month works out to something closer to 27%. So that's a very different backdrop than prior to this cycle. We've continued to realize that type of volatility this week that we're about to end, but it's been on the upside, and derivative markets react differently then, which Craig points out often. In my opinion, you could probably point to a handful of catalysts, and I know that Craig and his Tier 1 team were sounding the alarm bells about the relatively muted vols coming into July, the historically low levels of correlation, both implied and realized, and the potential for some nasty unwinds based on gamma exposure and, as he mentioned, systematic options exposure. And he can and should most certainly elaborate there if possible.
Yeah, definitely. Kevin, thank you for that background. And Craig, there's this narrative in the market that the desks are thin in August and it's related to one trade, or people are trying to pivot around the Fed. But what about the market structure when you're taking a look at the derivatives market? Why is that so key? What can you discern from there? What trend did you notice that led you to start sounding the alarm?
So when we talk about market structure, the options market is just one piece of that. Really what we're looking at is the options market, passive funds, and then the smaller subset, which are the systematic strategies. And it's really how all of these things are interacting together that drive this bigger picture of flows and positioning in the market. So specifically to the options market, we started to see dealer imbalances kind of lean towards negative gamma in the middle of July. And that was our first clue that we were likely to see realized volatility start to increase. And that's exactly what happened. So I know there's a lot of different catalysts that have happened over the past couple of weeks. And ultimately, we don't think it was one single thing that led to this. We think it was a combination of several events happening simultaneously. And then, of course, what happened in the equities market is very different from what happened in the VIX complex, for example.
Yeah, and let's explain that more at a higher level, Craig, for the benefit of the audience. Being short gamma, in my mind, it makes sense that you're going to see a vol pop there. Explain what the goal of options market makers are, on a higher level, what gamma is, and how it doesn't necessarily impact direction, but it can impact positioning.
Yeah, that's exactly right. So the goal of a market maker is to avoid making a directional bet. They don't want to be long or short the market. They want to maintain a neutral position because their ultimate goal is to provide liquidity to the market and profit off bid-ask spreads and collecting premiums. So the way that dealers can sidestep some of that directional exposure is through a process called delta hedging. And that involves buying and selling the underlying asset, which for these major indexes is usually futures. And that link between the options market and the futures market can actually either increase volatility in the equities market or, as we've seen early in the year, can actually suppress volatility in the equities market.
Yeah. I just want to ask you something about the volatility we saw last Monday. We saw spot VIX certainly higher than what was it, 65, and I believe futures were around 36, 37. Was that an indicator to you that perhaps this was overdone in terms of a vol pop? Because there's a narrative out there that, oh, it's the third highest volatility session that we've seen since the financial crisis, since COVID. But it seemed as if the move there wasn't quite as systemic as the GFC and the prolonged period of volatility that we saw during COVID. I would think the futures market perhaps could have given that clue.
Yeah, that's correct. I think what happened with the VIX was a bigger story of a liquidity issue, right? That's really where a lot of that stress came from. Dealers were trying to chase these long VIX positions after hours, and there just wasn't enough liquidity in the futures market to really chase that higher. So what happened there is not what we saw in 2008. It's not what we saw during the pandemic. It was something a little bit different. And I think part of that story that a lot of people haven't been focusing on is the effects that zero DTE have had on either a longer term hedging or shorter term hedging. And we've seen this shift away from specific to the VIX, these 30-day contracts into shorter term contracts. And what happened last week, we believe we saw what happens when those 30-day contracts are re-engaged in size.
Yeah. So Kevin, let's end this on a positive note here. Let's use this as a teaching lesson, a learning lesson. Let's say you don't trade options or you have a limited knowledge of it. Perhaps you're more involved with equities. It's still important to have a basic understanding of what's happening in the options market to help you think how you're positioning your portfolio or what to expect around a specific event like earnings. How could novices in the options market, equity-only traders, use some of this information?
So that's a really good question. And to your bigger picture point, the options market is rich with information, whether you use options or not. And I think Craig and work like his can point that out in relatively plain speak. Now, your example of event-driven expectations is a perfect one. Many people point to looking at the money straddles ahead of something like NVIDIA's earnings later this month. And if you look at that right now, it's implying something in the ballpark of a 10% move around that announcement. That's a plus or minus move. And so if you're holding an equity position, the market's kind of telling you you should be comfortable with the prospect of a 10% move around this event. If you think about what else is on the calendar that Tier 1 points out as well, we have the Jackson Hole Symposium coming up next week. We'll get a whole lot of Fed speak. We'll get Fed minutes. And in index options now, these short-dated options and the growth of them allows market participants to really target that exposure and to be precise about what type of information they want to be exposed to and in what way. And so I think that's a powerful outlet. Again, whether you use options or not, that information density is worth its weight.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.